Good afternoon, everybody. I'm Jeff Garrett, Dean of the Wharton School, and it's an extraordinary pleasure for me to be here with all of you for what's going to be a fantastic conversation between two extraordinary investors and business professionals. Welcome to the Howard Marks Investor Series, and the guest in conversation today, as you all know, is Stephen A. Schwarzman. Very brief bio introductions for two people who need no introduction. First, Howard Marks. Howard Marks is a treasured alumnus of the Wharton School. He's a pen parent. He is a former trustee of the University of Pennsylvania, and he served before that on the Wharton Undergraduate Executive Board. He's also an incredibly generous philanthropic supporter of the university, including a chair in behavioral finance and economics that I'm trying to fill for Howard right now. In his business life, he's co-chairman and founder of Oaktree Capital Management, a global alternative investment management firm with over $100 billion in assets under management. And I'm going to make a plug for Howard, a recommendation to you all, which is that the Marks memos on the state of the economy and investment opportunities are just fantastic. And in addition to the insights in those memos, Howard writes beautifully with real wit, and most recently he's become a multimedia star. You can see him on the couch delivering a memo on Freud's psychology and investment. And I don't think Howard knows, I have to say for my brother, that On the Couch is the most popular TV show in Australia on Australian rules football. I don't think that's where Howard got the inspiration for On the Couch. So what I can tell you is that Howard's memos are not only available to his investors, they're available to all of you, and I'd recommend that you go to the Oaktree Capital Management site where you can sign up for the memos. In addition to all of that, Howard supports this lecture series, and he acts as its recruiter-in-chief. And I actually think I was there when Howard made the ask to Steve Schwarzman to come to be with us today. Steve is a pen parent. That's an important connection for us. For all of you, the reason you're here, I guess, principally is because he is chairman, CEO, and co-founder way back in 1985 with Pete Peterson of Blackstone, the largest buyout firm in the world with over $300 billion in assets under management. Of course, for the Wharton School, our relationship with Blackstone is a real source of pride for us. Two of Steve's wonderful chief lieutenants are our alums, David Blitzer and John Gray. In the last decade, Blackstone has hired for permanent positions or internships 60 Wharton MBAs, and right now the total stock of Penn alums working at Blackstone exceeds 100. In addition to Steve's incredible life leading Blackstone, he has been a transformative philanthropist. The New York Public Library, his alma mater, Yale University, and Schwarzman Scholars and Schwarzman College at Tsinghua University in Beijing, which really is the Rhodes Scholarship of the 21st century. And I couldn't be more pleased that in the inaugural class of Schwarzman Scholars who will begin their study in Beijing in September are two graduating Wharton students, both of whom are here today, and one recent Wharton alum. I have to go back to Steve on the Australian theme. I was disappointed in one half of me that there are only 2 Australians in the first class of Schwarzman Scholars, but I'm so proud that there are 3 Wharton students in that first class. Could you please join me in welcoming these 2 extraordinary individuals to the stage?
Thanks. Thanks, everybody, for coming out for this. We've had some good crowds in the past, but I think this sets a new record. I'm very proud of your turnout. Jeff did a great job with that generous introduction, but he missed his cue because what he was supposed to plug wasn't the memos, but my book, which as I understand it, is still available for sale. Anyway, it's a great pleasure for me to have Steve Schwarzman here, my buddy of 45 years now, and we're going to dig right in. I have a lot of questions for Steve, and then we'll have time for some of yours, I hope. Steve, just to start off, would you tell us something about your early years, your career progression to the doorstep of creating Blackstone in 1985, hopefully with special attention to your success in the military?
You know, Howard and I were in the military together. That's not as fashionable a thing to do, and I forget whether we were dental assistants or,
right.
You know, for those of you who need dental care, Howard's your person, and I could help him. You know, my career, actually, I'm from Philadelphia, and I was born in Northeast Philadelphia, and then we moved to the suburbs, to Abington, Pennsylvania. Sounds like one graduate of Abington High School. Actually, we had about 900 kids in a class, 930 or 940. So it was a small, intimate experience. I went to Yale after that, and then to Harvard Business School. My dad graduated from Wharton in 1940. And my son, Teddy, went to Penn. He didn't go to Wharton. And so we've got, like a long connection. I used to look at my dad's University of Pennsylvania ring, of all things, that he had. So I joined Lehman in 1972. It was really interesting. It was a completely different world than we had now. I mean, the whole corporate finance department of Lehman, that was probably the number 3 firm at that time, was 40 people. It's hard to imagine. It was great for learning because we didn't have what people have now, which are specialists. Everybody's a specialist at something. And we were all just generalists. So if you were in corporate finance, you did literally every type of activity. From rating agency presentations to private placements to equity offerings, debt offerings, mergers, anything that somebody needed, you did it. And I think that was a really important element of my career because you sort of knew something about everything. And that way you could sense trends and changes and so forth, and Lehman, for a variety of reasons, ended up in an out-of-control situation where, we had some very large trading losses, and I sold the firm. I guess I was 35 at that time to American Express Company, and then I left a year later and started Blackstone.
So when you started Blackstone after 13 years of Lehman, 1985, the path of least resistance would have been to start another great investment bank. Yet you didn't do that. You went into investment management. What was the reasoning?
Well, what we did is we tried to figure out what could we do that everybody else in the world wasn't doing. And that's like an important way to think, not just try and be better at what everybody else is doing. So we actually spent, and this might be an interesting sort of lesson for you, we spent 3 months, just the 2 of us, meeting for breakfast every day, and this was the breakfast that lasted 3 hours, trying to figure out why we were going into business. What were we offering? So the strategic plan we came up with was first to go into the corporate advisory business, which is what we had been in. We knew a lot of people, and I finished up as head of the merger department at Lehman, and we had, at that point, the most active merger department. So that required no capital. It's always good to not need capital, because then you don't have to dilute your ownership. So we did that, and then as part of this strategic plan, the second piece was to go into what was called then leverage buyouts. And a lot of my friends were the young people who were starting the other firms at that time, whether it was KKR or Forsman Little. We were all within 5 years of each other, and these people had trouble getting anybody in the investment banking business to represent them, because they were very small companies and they had leveraged structures, and it seemed all risky. And because I knew them, I took them on as clients. And there was one very significant deal, which, if you study these things, it was called Hudai, which was about, I think from memory, somewhere in the $300 and some odd million, which laid out the whole structure of what was then, sort of a secretive type of thing called leverage buyouts. And you looked at it, and it was like an amazing way to make money, just amazing. And so I knew I wanted to do that. I tried to get Lehman to start that, and we actually got a deal, and it was turned down by the management committee, which is one reason why they ended up broke. There weren't always, great decision makers, in my view. And the third part of our strategy is because finance was going through this amazing, sort of consolidation after May Day in 1975, when commissions had basically been fixed for, I guess, 200 years. And it led to a lot of different popcorn stands with highly inefficient, sort of cost structures. And those companies started combining, and it became very clear that there was going to be massive increase in the size of firms. So when I joined Lehman, we had about 550 people. When Lehman died, sort of in 25 years later or whatever, it had 30,000. So I don't know what the compound rate of return is, but I'll tell you one thing. When I was at Lehman, I knew everybody by sight, a lot of people by name. When you got a firm that's 30,000 people, it's a veritable impossibility. And I thought that strategically there were a lot of people who like to be in smaller sized organizations. And what we should do is recruit those people when we saw an amazing opportunity, a market shift, something unusual happening, and that people who were 10s on a scale of 10 would be available simply because they just didn't want to work in these ever consolidating big firms that became impersonal. And that if we could start those businesses and have them generate intellectual capital, which we could use to make our existing businesses stronger, then we'd have like a great business. So that was the strategic plan, and we sent that out to sort of everybody we knew, and we waited for the phone to ring, and it didn't ring. Didn't ring. And so we must have sent out 500, hey, we're in business, and we're well-known guys, and let us represent you, and nobody hired us. So this is a very depressing moment for those who are starting things. So I said to my partner after we called everybody and nobody hired us, I said, what do we do now? He said, wait 2 weeks and call them all again. Maybe we'll get lucky. And we did get lucky. We had a company called Squibb, which was a pharma company, hired us for $50,000. I've never been more grateful for $50,000, because when you're an entrepreneur and you start something, we had $400,000 of capital, that what happens is every day you're open, you lose money. You pay the rent. We had sort of a secretary between the two of us. I didn't get her because I was the junior person. And, I had no secretary for a year and a half. I'd answer the front door, for God's sakes. It was a real change. Now, that 400,000, by the time I guess it was like last summer when the markets went down, it's like $52 billion. So that sounds like a good trip. But the journeys are always much rougher than people imagine. But the strategic plan of the firm never changed. It's still a great plan, and we're still executing on it, endlessly creating new things, but they got to be great. The opportunities got to be fantastic for the customers.
I think one of the things that everybody in the audience should take note of when Steve describes Blackstone's origins is the importance of what Malcolm Gladwell calls demographic luck, which most of us would just say right time, right place. And if you look at the private equity industry, when Blackstone started, and you look at the leading competitors today, Blackstone, KKR, Carlyle, TPG, et cetera, everybody's about the same age. The leaders are all our age.
37.
That's right, 37. And we were talking on the way down here today that we were lucky. We started at a time when this was a new field, and it was yet uncrowded, which is a great advantage. And I think nobody should overlook the importance of getting lucky. So you started off into the investment management business, which you hadn't been in previously. One of the things you need is an investment philosophy. So I'd like to ask where you got yours, and with particular emphasis on one thing. And you and I had lunch about 3 or 4 months ago. And one of Oaktree's main businesses is distressed debt. And being a distressed debt investor primarily consists of taking advantage of the mistakes of others, and largely private equity firms. They buy companies. The prospective return is higher the more leverage you put on. But if you put on too much leverage, more than the firm can live with, and it goes into a bad period, then it becomes distressed and it falls to us. And I was complaining to Steve that our portfolios over the many years have been, a litany of private equity firm mistakes, but Blackstone is underrepresented. And Steve just has not done his part to give us investment opportunities, and I asked him how could he explain that shortcoming? Why so few distressed situations?
Yeah, I'm sorry to disappoint Howard. He's a great friend. Basically, there are a lot of different ways to express this, but I hate losing. And the idea of losing money, really, it's just something that goes to the core of me as a person, and I just can't stand it. And if you start out delivering newspapers and cutting lawns and shoveling snow and doing all the stuff you did in suburban Philadelphia to make money, I worked at my dad's store. They paid me $0.10 an hour, and they said I was overpaid. And you don't want to go backwards. And part of the underrepresentation that Howard's talking about, it came from like our third investment. And we didn't have an investment process. This is the risk of starting a business when you don't know what you're doing, other than having great enthusiasm. And what happened is it was a steel distribution business. My God, it was also in Philadelphia. And what happened is one of the partners came in, and they used to handle this company as an investment banking client, and they said it was really good, and we could buy it. They knew the people, and one of the other partners heard that the deal was going on, and he came into my office, and he said, you know, I heard we're looking at this company, and you know, where this industry is in its cycle, it's really not earning money. They're all inventory profits, and if we buy this company at that price and leverage it, we're going to go bankrupt. And so, like, you know, sort of a good amateur CEO that I was, I listened to the two of them, and I decided on the person who'd worked with the company for years. And that company basically, you know, ran out of cash in 6 months. And I had this sort of searing personal experience with one of our investors called us, and he wanted to see me. So I went and I saw him. And in my family, no one ever raised their voice. I thought that was normal when I was being raised, but I realized when I met some other people that that's not normal. And so I'm very sensitive to changes in inflection and tone. And this person started screaming at me, and he basically said some very unappealing things, as you might imagine, and told me, among other things, I was the dumbest person he ever met, and regretted ever, you know, giving us any money, and that was just a warm-up. That was like an appetizer in a very long banquet. And as I was sitting there, I started feeling my face getting warm. And then it kept getting warmer. And then I realized I was going to start crying. I was so ashamed. I was so embarrassed because this person was completely right. I was stupid. And I allowed that money to be lost. It was $32 million, actually. And so I went back, and I drove back to the firm, and I said, I'm never going to let that happen again. I'm just never going to do it. I'm never going to be dressed down like that. I'm never going to be embarrassed. I've asked people to trust me. I've betrayed their trust. And so we set up a system, which we still use to this day. It's an amazing system. And what we do is if you've ever been in the service business, or not even just a service business, any business where somebody is looking for approval, if you don't approve their proposal, they think you don't like them. You don't value them. And so I realized that I had selected, you know, between two people, and I didn't have the right data. I didn't have any process. So what we set up is pretty rigid rules where anything we're going to buy or invest in, that there has to be like written analysis of that. I know that sounds primitive, but it's got to be in writing. It's got to be identifying all the risk factors, and with the objective of deciding how could you lose money and it could never happen. And then what we do is we put everybody around a table, and one of the key things that I figured out, I was like a psych major, right? So not business. And I realized that if one person was criticizing the deal, then the person who brought the deal and was leading the team wouldn't like that person. And they'd try and retaliate in some way, which stops everyone from being objective about an investment if it's not such a good investment. So what I insisted is that everyone around the table speak, and they could only speak about analytic weaknesses in the deal and risks in the deal, so that this was all geared to not losing money. Now what this does is it depersonalizes decision making, because if everyone is going through and talking about, okay, you've got like, you actually have 5 risks, not 3, here's the range of outcomes. That if you do that, and everybody is attacking you all the time, then no one's attacking you, right? And what we do is then we send that group of people back to answer questions that the group came up with. They send out another thing. You have to have 2 days to read these things and absorb them, to catch up with the team because they'll try and outfox you because they're smart. They're financial people. And so then you have another session like that, and you debate these risks even more. And sometimes you do it a third time. By the time you finish this, the responsibility for that investment no longer resides with that team of people. It's all the people at the table own that. And so if anything ever goes wrong, it's almost always one of those variables where we got it wrong. The team didn't get it wrong. We own it, okay? And that way, people are very comfortable going forward with things, and the chance that we lose money is really de minimis. And that's why we are a totally disappointing organization for Howard.
But that sounds like something everyone would do. So
They don't.
where do you think they fall down?
Well, they fall down a lot of ways, you know. First of all, they put somebody in charge of credit, who's in charge of risk. That's a person. They don't organize in this way. They believe that, you know, just sort of delegating to somebody setting it up as a profit center works. They actually just don't even understand how people behave. And so, you know, it's not really distributed risk assessment. And you know, they just trade off because it's easier to be lazy and not criticize what somebody else is doing, not to be criticizing the person. It's the substance. And I don't know why people don't do it that way.
So a lot of what we're discussing is not really investment matters, it's interpersonal. It's culture, teamwork,
Yeah.
and so forth. And obviously you spend a lot of time on that. Which are the things that you have had to work on hardest as you've grown, and what are your greatest challenges ahead in that department?
Well, you know, the key, nobody wants to be working in a big impersonal place. Who would want to do that? That's not fun. That's one of the reasons people start new businesses. So our biggest challenge is how do we keep expanding and keep the firm intimate and flexible and responsive. And so what we do is, you know, technology has solved this for us. And what we do is we have, you know, sort of offices all over the world. I think we're up to either like 26 or 28. But what we do is every Monday, each of our business lines, private equity, real estate, credit, or hedge funds, meets as a group. And you have, we have a big room, and then we have like television screens up, HDTV, except they're people you'd know because you work with them. And everything is interactive, and we first look at what's going on in the world, any changes in our companies or the things we own that we can see as a trend, and then we go over every deal in the world that we're looking at. And everybody is in that room, from a first-year person to somebody at my level, and anybody can talk. And anybody can ask questions about what we're doing. And we discuss everything we're doing. And so we're in the no secrets business. And so everybody is expected to pay attention and learn. And these are like, you know, for younger people, this is like having a master class. As the older people in the group start asking questions about things, questioning tactics or industries or what's going on. And this is actually a lot of fun because everybody likes being included. Nobody wants to be a subordinated work unit. I mean, you know, everybody is the same at our firm, except some people are just older. Some people are more experienced. You're not smarter than younger people. We're all the same. And so this way, people learn about cycles, and they learn where we are on cycles, whether it's, you know, a U.S. economy, whether it's global economy, geographic, by industry, and ultimately by asset class. And so we finished that meeting, and everybody in the world is fully up to date. our compliance people beat me up. They said, Steve, you take too much risk with information. And we've never had a leak in the firm's history. Never had one. I'm sort of brutal about confidentiality, and we run the firm like it's a small place. And then we finish with private equity at 8:30, and we do real estate at 10:30, and we do tactical opportunities at 12 o'clock, and then we have our credit business at 2, and our hedge fund business at 4. And so by the time you finish a day like that, you've learned so many things. Somebody lucky enough to be in my position, boy, it's fun. It's like watching television all day, except you can talk to the people and change the script. And I have a lot of fun, but by the time you see the linkages and the unique information created in each of these businesses, and they're all not correlated one-to-one from cycles. So you can get advance warnings of bad things happening so that other parts of the business of the firm can stay out of the way of that harm. And everybody feels like they're included, and the reason they do is they are. And that's how we run a business. And whenever we start something new, we bolt it on to one of those 4, and everybody comes to that meeting, and everybody knows what's going on. No secrets, horizontal, transparent, team ball. Everybody should learn. Anybody can speak. Sometimes I'll call on people to, not like a cold call in a class, but, like, what do you think? You're working on it. So they get a chance to speak in front of everybody.
So you've mentioned the importance of trying to keep a small firm ethos even as you grow.
Yep.
In 2007, firms in our industry, the so-called alternative investment industry, it became possible to be public. And you were, I think, the second firm to go public after Fortress, as I recall.
They were a little one.
Yeah, they were a little one. And, but...
By a month?
Yeah. Well, actually, I think it was 33 days. But
that's the problem with precision in finance.
But you would think that being public has some possible negative ramifications. How did you think about going public? What caused you to do it? What got you over the hurdles?
I was a little leery about it, and I had a partner who was retiring, and most of you would not be aware of this, but in the sort of early 1980s, there was a firm called Solomon Brothers, and there was a fellow that ran it named Billy Solomon, and he retired, and there was another guy who became the head of the firm named John Goodfriend, and he sold the firm like a year later, and Billy Solomon, who had been CEO for like 30 years, got nothing. And I thought that was reprehensible. And because Solomon Brothers started as a little nothing, and it became the biggest bond house in the world, and was a real achievement. In any case, so I had a partner who was retiring, and he could have gone out at book value, which was about nothing, and I thought that was like a bad thing. It was unfair. And I also had a sixth sense that the world was getting way overvalued, and I just wanted safety. I wanted more capital in the firm. I also thought it would be a good idea if something bad happened to me, that there was something left for my family. I didn't think that was a bad thing. I also thought it would be good to have a currency, because if we were going to expand or pay people, that would be a good idea. And before, when we were private, everybody owned a big stake in their own individual product line and a little bit across the firm, but this way we could use stock as something that would bind everybody, and I thought that was a good idea. I thought going public would be a great branding thing for the firm. Little did I know that we exceeded that. And finally, I thought there would be an X factor I didn't know whether it would be good or bad, but something big was going to happen as a result of it. And we really got overdosed with that one. We had the government, sort of wake up and different interest groups like attacking us for reasons that I never had imagined previously. But then we had 3 countries who decided they wanted to be major investors with us. And, it's one of those sort of polygamy discussions where you say, how many of these people can I deal with at once? And they all were desirable, which is, I guess, why there was polygamy at a certain point. And so I had the luxury of decision making, and we chose China. Now at that point, China had not invested in any company in any scale outside of China since World War II. So we became accidentally, and we didn't ask China to do anything, or any country. They just came out of the woodwork. That we became like a partner/symbol with China. It was the most amazing strategic thing I ever could have imagined. And the IPO itself was the second biggest of this decade. I don't know what to call it, from 2000 to 2010. Is that called the noughts? Right. Or I don't know what you call that decade, but the only one that was bigger than us was Google. And it was really like an amazing experience. And what we did, because I was very concerned about the conflict between being public and managing money for institutions, that I was really very difficult. I'm not really a nice guy, but I can be difficult. And in this context, I didn't want to have this conflict. And the only way I could figure out to resolve it was to have no fiduciary duty to our public shareholders, because I knew we had to have our fiduciary duty to the funds that we manage. And we had to be able to buy things at the right time and sell them at the right time and do the best possible job in the world managing money. And if that worked out fine, then the monies that were passed up to the parent company would be great. Everybody would prosper. But if we were worried about what to do from a fiduciary point of view for the parent company, then we might end up doing the wrong thing for our investors, and then they wouldn't like us, and then there's really nothing that you should be in business for. So I wrote a section in the prospectus that said, we are not a normal public company. That was a great hit with the underwriters, and they said, what do you mean you have no fiduciary duty? I said, well, you can't have 2 masters. And we're picking the people that we manage money from. And as a result of that, I'll take next to no compensation. I'll just take a draw. And I'll make all of my money with distributions from the parent company. So people will understand that I can do 2 things at once, but ultimately I want to make the right decision for the fund people, and that was the only way I could figure out how to avoid having that conflict, and actually the firm runs now exactly the way it did when we were a private company. There's been no change.
The way I put it is, you don't have to make mistakes just because you're public, and you are perfectly able to make mistakes even if you're private.
Yeah,
as long as you have your head screwed on right.
Yeah, well, you try and do the right thing in every situation.
Yeah. What has been the impact of being public? In particular, you've been quite vocal about the fact that your stock is 75 to 80% undervalued. And what makes you think that? And when I went to Wharton, we were taught to ask, is it possible that you're wrong and the market is right?
It's possible, but unlikely. The way we value ourselves is pretty straightforward, easy to explain. We took like a 12% growth in assets under management, which is way lower than what we've been doing. You can sensitize this, but I'll give you the assumptions. We took what we've earned historically on our investments and lopped off around 200 basis points to be conservative. We could be wrong on that. It could be higher, it could be lower. And we set up a 5% dividend yield, and you multiply it out, and you get like $130 a share, and the stock's at 26. So that's over 10 years, right? So I sort of look at it and say, could we keep coming up with new things and expanding? And there are no acquisitions in that. It's just regular old organic growth. And even if you knock it down to, I think it's like 6%, which is like almost doing nothing, because we've got the best performing asset classes in the world, that, you know, then gets to like 100. But any way you cut it, for us not to be able to do these types of things, you'd need a dramatic reversal in returns, or some kind of sort of huge change in the ability to just raise money. And I think both of those are pretty unlikely, and it's just math, and that's how I do it.
I think that in your answer to one of my previous questions, you allowed the possibility, which I'm sure came as a shock to everybody here, that you can be difficult.
Not really. Friendly and lovable.
For the and yet, part. I think that you and Blackstone have done the #1 job in the industry of putting together a management cadre. You've got yourself and Tony James and Tom Hill and Bennett Goodman, and you got John Gray in the younger generation. What's the secret to assembling and maintaining such a high-level group?
Well, part of it is dealing with everybody in the same way that I said. I mean, it's a level organization. I have, sort of all the votes, but we don't share that widely. And everybody is gifted at the firm, and we're all trying to be the best in the world at what we do. And there's great synergy intellectually, knowledge-wise, between what we all do. And we run the firm in a horizontal way where, so the heads of all the different businesses and our general counsel and head person for, sort of strategic planning, we meet every Wednesday. There's a feeling of excitement. Our businesses have grown, 15-20% every year. This is like magic, and we're all involved with it. We all help each other. We have a culture where we had a lot of. I'll tell you one funny story about my first day at Lehman Brothers. So I go to work, and I'm waiting at the elevator, and one of the partners greets me, and he says, "You're one of the new people?" And I said, "Yes." And he said, I just want you to know that you'll like it here at Lehman Brothers. And I figured, yes, I'm very enthusiastic about this. And he said, you don't have to worry about anybody stabbing you in the back here at Lehman Brothers. We just walk right up to you and we stab you in the front. and I was in that culture for 13 years, and I buried the firm. As a kid who was 34, 35 years old, it was really a tumultuous period for me, watching the grown-ups just completely screw up the thing and have no courage to fire the head guy or do anything. And so when we started Blackstone, I wanted to make sure we only had nice people working at the firm. I had no appetite for dealing with nasty pieces of work. And so we have a culture that's very supportive. It's all meritocracy. And the key to growing and keeping a great culture and providing a place for everybody that's exciting is to keep expanding the business, because then you never have this glass ceiling question where you have to kill off somebody else so that you can have something to eat. It's so much better to just keep making the pie bigger. And then what you do is you start these new businesses. They're great for the investors because you're making terrific returns, but you also can swing out younger people and put them in positions of authority where they're growing. So the whole thing is a virtuous circle where it's exciting, it's fun, everybody's doing well, and we're very objective in assessments of people with 360-degree reviews, and it's like playing fast break basketball on a team that wins the NCAAs. I mean, what was more exciting than Villanova? Yeah. Holy cow, that was like amazing. And that's the feeling we get at work.
The interesting thing is that, again, as you said about your culture of avoiding losses, it all seems so obvious. You know, the things you do seem so compellingly clear.
Yeah.
I think we try to do a lot of the same things and run the company on the same culture. But again, interestingly, it comes down to, so why not everybody? But the answer is not everybody.
Yeah, well, you know, geez, some people don't understand what business they're in.
Yeah.
We're in the intellectual property generation business, right? I mean, that's our business. And other people think they're in finance, or they're doing something else, or they're incenting people, or they're, you know, that's just like supporting cast in terms of what you're doing. So, you know, Howard, we had a pre-meeting with some of the students, and Howard is very, very good at defining, you know, that it's necessary to know what you're doing to be able to create it, whether it's a tax code or other types of things that we were talking about. And so we have a pretty clear idea what we're doing, and, you know, all this stuff is like very straightforward and supportive. And one thing that enables that, Howard, is I'm sort of there for life. Yeah. And, you know, it's like a benevolent type of thing. And, you know, I'm not this animated at work because I'd scare everyone. So I can scare you now. But, you know, you actually, being a CEO is a learned behavior. No one is born as a CEO. And I used to be a deal guy, and, you know, there was just a certain amount of stuff there, and if you got it, the other person didn't, and that's a different culture. As a CEO, you have to be much more measured and thoughtful and caring and supportive of people and process, and you know, you have to have, you know, sort of courage to do things and make changes, but you define the culture. You define what you want people to be, what you want them to do, how the organization's going to work, and then you don't budge on core principles. You do not budge. And if you're consistent and you're there forever, then you don't have political infighting to be somebody because, you know, I'm not like moving. I enjoy what I do. So you're stuck with me, and everybody else is judged on a meritocracy. And you must be careful and uncompromising on meritocracy so people trust you and trust the system.
I want to ask you a couple of questions about our business. If you were starting a business today, what would it be? Would it still be asset management?
Geez, I get asked that a lot.
Yeah.
You know, in today's world, there's still some great things in finance. I mean, finance is a wonderful type of business. It changes like all things. I mean, today you have machines beating humans in the hedge fund business, right? That's certainly a change. You have technology just sort of generally providing fortunes for young people. I mean, all you need to do is start an app and every young person in America is going to be worth at least $2 billion, right? I mean, and so the world keeps changing as to where the maximum, compensation would go. Finance is still a good place as long as you're not, exposed to this kind of regulatory regime, which I'm not sure it makes these companies any safer, by the way. Sure. But it's the world that, politically we're dealing with.
So you've been doing this, as I have, for 45 odd years. They were odd years. And, you've put some money by. So how do you feel about continuing to work?
I love work.
You're past retirement age, by the way.
It's so exciting. I don't know what you would do just sitting around. Golf is not that interesting, and tennis, the problem is your parts start wearing out. Yeah. So it's not helpful for your knees or your back or your shoulders. And, sort of my grandfather worked till he was 89. So I have like role models of people who do this. I don't think it's work. If it were work, I wouldn't do it. Yeah. But it's so exciting because we're people like Howard or people like myself, we're just so fortunate, leaving aside any financial dimension, that we deal with people all over the world. We deal with people in government, the largest financial institutions in the world. We own companies and real estate and all kinds of things, and trying to figure out what happens almost everywhere in the world, because in the internet world, everything starts impacting something else. It's like a really complex puzzle, and it's not even convenient like a jigsaw puzzle. It keeps changing every day. And so trying to master this, trying to figure it out, and at the same time being good for society and helping people, this is really a feast. And it's the recipe for just a wonderful, full life. And you add in philanthropy to this, and endless education, and teaching people, teaching younger people at the firm, or even middle-level people. It's an amazingly full kind of life, and I couldn't imagine purposely denying yourself that. By the way, you can still take vacations. You can still go places. You can see things. And I encourage you to have this type of engagement with life. There's something wonderful about, lifetime learning and intensity and sort of continually, sort of learning and testing and teaching and giving to people. It's a good thing.
You mentioned in that answer the subject that I want to end on, and that's philanthropy, because your philanthropy has been pronounced and targeted, big sums for the public library, for Yale, most recently for your scholars program in China at Tsinghua University, and we're going to have 3 Wharton students going there next year. So I wanted to ask you, number one, to discuss your attitude toward philanthropy in general, and then number 2, to talk about the China program and how you came up with that particular idea.
Well, philanthropy is an interesting thing because people have different financial resources. And the key, my grandfather used to, sort of send, packages of stuff every month to Israel for an orphanage there. And I watched him do that. And, that was sort of like training for doing, in effect, good works. And so philanthropy doesn't have to be limited to wealthy people. You can help out just by being yourself and donating your time and changing other people's lives. And you can do it, sort of personally, and you can do it with financial resources. I like doing things that are really going to change something. I sort of do that at, at, at work at Blackstone, and philanthropy is an outgrowth of that. And I like doing things, and there are all kinds of different tastes in this area. I like doing things that are big because I like to be involved with them. I still do stuff like we all do in New York. If you're affluent, somebody always wants you to buy a table at something or give some money to a benefit or support them, and that's fine. You can do things like that. But that's somebody else making the impact, if you will. I like to do things personally to change things. And so I look around for interesting big issues that I look at and say, geez, if we did X and Y and Z, wow, we could really make an impact. And there's no recipe for this. Everybody looks at these things differently. But in China, I had the accident of China buying into the firm, and I got to see the hostility that some people took. I had one very senior political figure in the United States making announcements about how the Chinese government was controlling Blackstone because of their ownership. Well, basically they had no non-voting stock and no board member. I don't know whether we have any corporate governance experts out here, but that sort of takes care of that issue of control. And that didn't stop him. And I called the guy, and he said, I don't care what the truth is. I just hate these people. And this is like, you would recognize the name. So you have an experience like that. You sort of look at it and you go, not good, not good. Not a good way to have a safe world with somebody like this running around. And I also saw in my travels, particularly in the Middle East, they usually have nice dinners for you with a lot of friends. And what happens is there are always people who went to U.S. universities in the Middle East. And what will happen is they'll start discussing something, and the discussion goes in a really weird way. And then somebody says, I went to Georgetown. That's not how it works with the United States. They don't really mean to be offending us, or they don't really. And then everybody just stops talking, and they accept that person because one, they have superior knowledge, and two, they trust their judgment. So I looked at this vis-a-vis China, and I said, look, it's only a matter of time before the growth in China, whether it ends up being 5% or it's 6.5 or 9, with the wealth transfer that's going on there and the developed world not really responding competitively, that there's going to be envy and problems directed at China. And I happen to know how the Chinese react to being, sort of threatened. And it's not a pretty picture. And I've been in some situations where I've been used to run messages back and forth, with governments, and you just don't want to be in this movie. This is a very bad movie. And so I looked at this and I said, well, geez, what could we do to ameliorate this situation, to minimize the difficulties? And I found that there was a study that one of the Harvard professors had done that said that since the year 1500, there have been 15 times there's been a challenger country challenging an incumbent. China is a challenger in the U.S., is the incumbent power in the world. And there have been wars 12 of those 15 times. And I said, I got to do something about this because I have the ability, I have the knowledge. Let's do something to address this problem. It's a big issue. It's like a world issue. The two biggest powers in the world could end up getting sideways. And what the probability of that is, whether it's 12 out of 13 out of 16 or whatever it is, it's way too high. And both countries don't see the other one in a normal way. So I looked for a model, and the Rhodes was a good model of picking terrific people that, in this case, would be going to China instead of to Oxford, and select them to be future leaders in their fields, influencers, whether it's sort of political or whether it's business or whether it's media or whether it's academics. These are people who will get an unusual look at China and be able to go back to their countries and explain China. So to create that, I was on the board of Tsinghua Business School, where it's just the tech representatives. It's like one of the most amazing boards in the world. The tech representatives are Mark Zuckerberg, Jack Ma, and Tim Cook, right? Those are just the tech guys. And then, it's sort of comparable in other areas, and they have the deans of the major business schools on it. It's fascinating. And then they have the senior people from the Chinese government. And so I see these people, like all the time. And Tsinghua is unique because it used to be an engineering school, and when, after the Cultural Revolution, what happened is that the new head of the country, Deng Xiaoping, who brought in capitalism, basically said China's got 2% of global GDP instead of its normal 20 to 25 historically. We got to rebuild the country. So what do you need to rebuild it? Engineers, okay? So Tsinghua was like the MIT. So they hired all these young people, and they're still hiring them. Those people are now in their 60s, and guess what? One of them's the head of the country. The previous head of the country was one of them. The head of the central bank is one. The head of the finance ministry is one. The head of the environment. They're like everywhere. So for us, this is like phenomenal because we can get our students at the Schwarzman Scholars to meet these remarkable people who are running this giant country. We can get the mentors from the top people in China. So going to the Schwarzman Scholars isn't just getting a master's degree and going to school. We're going to introduce people to a level of China that they really can't get anywhere else. And we'll take them on trips around the country. And this is like not an academic year for all of you academic people. I don't know how often you go to school, but it's not as intense as Howard's job or mine that never stops, right? I mean, our year is like on duty 24/7. So, you'll get Christmas off, but basically, you're going to school for a year, but you're going to work for a year. So it's like about a year and a half to a year and 3/4 of an academic year. And so we built a completely, sort of unique facility that's got great air, pollution control and water control and all those awful things so that, we don't do anything bad to anybody. We're launching, we got the most amazing response. We had a 3.7%, sort of acceptance rate. What do you call that? We had 3,054 people apply, and we made 115 offers, and we got 111 people. So if you look at graduate schools, then we got a 96% acceptance of the people we offered. I mean, geez, that's better than any university.
That's called the yield.
A yield, okay. So it's better than like any university that I know of, sort of anywhere. And so that was just the first year, and the students, of which I guess 2 are here, but 3 are accepted, are like fantastic people. So it's for me, I mean, I've treated this like Blackstone. It's a startup. Yeah. And, we're out raising money, and it's so painful when Howard goes out to raise money, because he's got a great organization and a great reputation. He probably gets money 9 out of 10 presentations, maybe 9.5. It's sort of the same for me. I'm back to 1 out of 17, right? Asking people to give money. So we're up to 388.6 million, but who's counting? We're going up to 450, and this will be endowed forever. So that's a long story, but it's so exciting for me because it's in a different area, and now we're known all over the world. And you know, I want to really do something that I think is important just for the world, and you know, that's the only motive.
Well, it's a great story, and I hadn't heard it in full before. Steve has a long trip to take tonight, and I'm going to get him on his way.
Yeah,
but I
gotta
hope
go
you
to
all
Europe.
join me in thanking Steve for being here with us.
Can I just add my thanks on behalf of the school to Howard and to Steve. Steve, you know a lot of things. Let me tell you 3 things very quickly. Ben Bernanke is going to be sitting in that seat tomorrow, talking with Jeremy Siegel, who's going to impersonate Howard Marks.
Yeah.
2, you wondered how long students work. The reason there was attrition in the classroom in this auditorium is because there are 6 p.m. classes at the Wharton School. Lots of people have gone to them. And last but not least, in terms of the US-China, Howard Marks is a foot soldier in your army. I was there when Howard was trying to hew a win-win business engagement strategy between the US and China when Colin Powell and the former Chinese foreign minister were going at it. A fantastic session for me. Thank you, Howard. Thanks, Steve, very much for being here. Thank you.
Well done.